Hello traders, Gary Wagner here, just about 11:30 in Honolulu, 5:30 in New York. It is Thursday, 18th day of May, 2017, and this is the Daily Report for Gold and Silver. After experiencing a nice multi-day, multi-week rally in the precious metals markets, we did see precious metals prices softening today in response to a stronger equity market as well as a strong US dollar. Of course, that does affect our current long positions in both gold and silver. And to that end, this morning, I sent out a special trade alert with recommendations of where to trail your stops up to. Of course, we'll go over that in detail once we pull up our charts, and we'll mention them casually as we talk about net changes in terms of pricing. First, to gold, 1246.80 settlement price of gold futures puts it down about 1190 on the day. That is a drawdown of almost a full percentage point. Now, the low on the day, and that's what's critically important, is 45.70. Kind of keep that in the back of our heads. The high today was just above 65, 1265. And as you can see, we've closed much closer to the low than the high. As I said, giving back about 1% of value. Now, silver, of course, sold off, but sold off in terms of a percentage drawdown to a much greater extent than gold, actually doubling the drawdown today. Silver closed off by 2% on the day, 1656.5, off 31 cents. As you can see, the net drop is 2.02. It's traded to a low today of 43, and the high today, was 94. So we've seen quite a considerable range in silver, but it did sell off by about 2%. As I said, we did move our stops up. We'll talk about it in detail, but your stop in gold should be just below 1245. Stop in silver, 1641. And as we pull up our first chart, we will explain the rationale behind why we placed our stop where we did. No doubt a pretty strong drawdown in both gold and silver. Silver really exhibiting a pretty advanced drawdown, losing about 2%. First, I do want to apologize for coming to you a little bit late. Working on the stops was really priority one to me, and knowing that the show, even if it is recorded a little bit later, as long as we've trailed our stops up to the appropriate place, I'm putting my time really where it needs to be. Now, let's talk about the stops. This morning, I sent out a special trade alert recommending that all traders actually go ahead and raise stops. If you recall from the trade itself, as we put this on, market was roughly, 1225? And that would be this day right in here. In fact, let me change the color of the marker. But the one thing that we noted as this market came up was that to have an effective stop, we really wanted it to account for the recent lows. And the recent lows, of course, occurred on the 9th of this month, and they came in roughly, I believe, at about 1210. That would be our low right here. And so our initial stop in the market was buy at the market. We got in at 1225, stops below 1210. Today I sent out a special trade alert recommending that you move your stop from 1210 to below 1245. Now, first, obviously, it locks in the profit differential between current pricing and, or I should say stop point, which would be below 1245, whether you have it at 1244, 1243, and our entry price. So we're locking in just shy of $20 on this trade if, in fact, it does come in and knock us out. The reason for putting it at that price point was a basic fib retracement, and the fib retracement that we are calculating is a very, very short-term retracement from the onset, or 1210, up to this recent top at 1264, and that did occur today. So we do have a dark cloud cover in terms of a 2-day candlestick pattern. It's not something I'm going to focus in upon yet, but it is a sizable market move, roughly getting back about half of the gains witnessed yesterday. Now, when we do this short-term fib retracement, as I said, 1210, 1265, the key areas that we want to look at, of course, is going to be a 38% retracement. That would be a shallow retracement. Of course, a deep retracement would take us to 1233, and my personal feeling is this would more likely be a shallow retracement than a deep retracement, especially because we're coming off of such a strong downside pressure that was evident in the market as the market came down from 1300 down to here. So, traders, maintain your long position, maintain your current stop below 1245. The rationale for placing it there is we're placing it below a 38% retracement of the most recent rally price range. And traders, as I spoke about in the opening statement, we did see silver sell off with a percentage gain roughly double that of gold, silver drawing down about 2% of its value as it closed 34 cents lower on the day. Now, we're looking at our daily chart of silver. We are also looking at the most recent rally, starting on the 9th, the 10th. Market's trading at roughly $16, takes us up to the high at 17. So we had roughly a full dollar range. Fairly sizable range indeed. And when we look at today's drawdown, here is what's interesting. If you recall, the low of the day in gold took it to a 38% retracement. Now, when we look at silver, the low of the day is just shy of a 61.8% retracement. That is your deep retracement. And that matches up pretty eloquently to these lows here. Now, in the same way, we entered our long position in silver right after the market began to clip up. Our stops were sitting initially below the lows right in here, so below 1606, I believe, is where we recommended it. What is important now is we are moving our stops up so that they reflect this recent low and, more importantly, reflect a break below a 61% retracement. Because if the market can find support and begin to move higher from this area, this stop will hold. This is as deep of a retracement as you'll typically get. You can get it going to 78, although that's a rare occurrence. We'll just have to see how this unfolds over tomorrow and then the beginning of next week. So my recommendation is obviously to maintain our current long positions and to maintain our stops at the new level of which they're at. In other markets that we follow, as we spoke about on the opening statement for precious metals pricing, we did see a return to upside action in U.S. equities. Respectable modest gains in both the Standard & Poor's 500 and the Dow Jones, both closing up about 1/3%, 56-point gain in the Dow Jones Industrial Average, closing at 20,663. When we look at the Standard & Poor's, that also closed up about 1/3% higher at 2365, but it was the NASDAQ that once again shined in terms of performance, closing up almost 0.75% at 60.55, and I think the news in the NASDAQ, it is not on pace to close at an all-time record weekly high as we sit right now. And that would be the first time in the last 5 weeks we can actually make that statement. That is a rarer occurrence than closing at a new all-time high on the week. And then lastly, do want to take a look at the dollar. The dollar had gained a lot of emphasis and a lot of value in the morning session, still closing up about 1/3%, but well off of the highs as traders ponder the net effect of the legal actions and the investigation going on in Washington. So traders, lastly, the one market that I do want to look at today that's not a precious metal is the U.S. dollar index. Dollar index showing some moderate gains today, closing up about 1/3% and closing at 97.76. The key to me is the fact that we saw the dollar substantially break below its moving average, the longer-term 200-day moving average, and it did that on Friday of last week. That was followed by 4 consecutive lower pricing days in a row. That took us up till yesterday. We opened below that price point today and closed really at the midpoint of yesterday's candle. Let me go ahead and blow that up. And in terms of a 2-day pattern, in candlesticks, this can be identified as a piercing line. Piercing line is after a defined downtrend. We certainly get that. Long red candle, you get that. You get a day in which it opens below but closes at or above the midpoint of the prior candle. We meet all of that criteria. To take this as an effective trading call, you would want a confirming candle. A confirming candle for any bullish reversal is going to be that on the following day, first of all, it must be a green candle, which simply says that the market must close higher than it opened. It must maintain a higher high and a higher low than the previous candle, which would be this green candle right here. My sense, however, is that we could just be looking at a one-day wonder. I think that longer term, in terms of trend itself, we should see the dollar drift lower through the summer. To me, the most critical piece of information about trailing the stop today is that we have locked in profits on the trade. So regardless of the outcome will be a profitable trade in either gold, silver, or both. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.